Hi, I am Rahul Shah and I am ready to reveal the only training program you will ever need to build your own Forex millionaire portfolio. Join me at the Lazy Millionaire Summit on 24th January 5 pm. Click on the link in the description to block your free spot.
Hello friends, this is Vijay Bhambwani here and I'm back with this video to tell you about a very important trigger point, a bullish trigger point for the market. Last time I talked about this trigger, the Nifty was at 17,532 as you can see on the chart on your screen right now. In spite of the fact that crude oil has run up, natural gas prices have run up, there are worries and talk about interest rate hikes the world over and inflation is raising its head all over the world. The Nifty has not only managed to hold firm, but it has risen from that data point. As I record this video on Tuesday, I am seeing that the market is falling off sharply, but we are still above this level. So what's really keeping our market up in spite of the fact that FIIs seem to be selling equities? There is a general sense of despondency and worry in the market. Of course, we also have positive triggers and hope of a budget, which is predominantly a bullish period. And in the run up to the budget, people trade with bullish expectations. I'm going to share something with you, which is, in my humble opinion, being vastly overlooked by the overall market watching segment of traders. Now, on 1st of October 2021, I had recorded a video in which the title of that video, by the way, you can scroll down in this playlist. You can see that the title of the video was Get Ready for a Boom. And my logic for saying that I'm expecting a lot of money in India through a source which is not being monitored enough. People in the know, smart money that is definitely watching it, which is why the market is up. Now, recently, I chanced upon a very bullish kind of breakthrough in the bond collections by private sector companies, starting with Reliance Industries, SBI, JSW Infra, Shriram Transport. These are all listed companies, and there was one unlisted company called India Clean Energy. All these companies put together between the 1st of January 2022 to 14th of January 2022 collected $6 billion. That's right, $6 billion. That's a little under 45,000 crore rupees. Now, this happens to be 3 times more than what corporate India did in the year 2021. Now, we have an even bigger trigger coming in, where FII money will come in through the bond route, but unfortunately people are fixated on looking only at FPI inflows into the stock market. Am I saying that the market will never fall? I'm not saying that at all. The video is purely about a bullish trigger. Of course, if the markets have to undergo a correction due to other reasons, there are a whole lot of other triggers: corporate earnings, taxation, elections, act of God, man-made crises like geopolitical stress going on in the Middle East and in Europe, Eastern Europe. So all those can take a toll, and the markets might correct. But I stress upon the fact that Indian markets will not correct as much as their global peers. As I recently said, even in my video last week, about why Indians should not worry about or worry too much about the taper tantrum that is expected after the Fed starts to raise interest rates. Now, the Indian sovereign bonds, these are bonds issued by the Reserve Bank of India on behalf of the Government of India, which are guaranteed by the central government of India. These are called sovereign bonds, and I've made ample number of videos. If you go down in this playlist, I've even given you a window of opportunity called the Retail Direct GSEC scheme on the RBI's own platform, wherein you can buy and sell bonds without any intermediaries, without cost commissions and other execution costs. So the government has played a very smart move and asked for inclusion of the Indian sovereign bonds in the global bond indices. If that happens, now bond investors will want to align with the same weightage. You see, it's like buying an index mutual fund, an index fund or a Nifty ETF. The fund manager buys all the stocks that are in the index in the same weightages that they are present in the index so as to match the index returns. So after India's sovereign bonds are listed in the global indices, a debt fund manager, a global debt fund manager will by force have to include Indian sovereign bonds, which means every year, if the official estimated figures are to be believed, every year anything between 25 to 40 billion US dollars will come into India through the bond route. You could argue that this is debt. Yes, it is. But remember one thing, that this will provide ample amount of working capital to the government of India, and if for any reason we fall short of the disinvestment target or due to any other collections going down from any other sources, this is a very healthy buffer that the government gets to play around with. And don't forget, this is not hot money that flows out at a moment's notice. This is long-term money coming in from pension funds, coming in from institutional investors who will not ask you questions for the next 7, 8, 9, 10 years. So it gives you a whole lot of breathing space. It allows you to carry out your infrastructure projects, your developmental projects, capex, etc. And this is, in my humble opinion, a very good thing to do. I think a silent revolution is being triggered off by the bond market, both on the domestic investors front by way of the RBI's Retail Direct GSEC scheme and inclusion of India's sovereign debt in the global bond indices. For the next 10 years or so, I would not worry about monetary inflows coming in from FIIs through the bond route. This is extremely healthy, extremely positive. Like I said, markets will still correct if they have to due to some other worries. Not because of taper tantrum, not because money is flowing out of equities. Hey, if that is being matched by inflows in the bond market, why should we bother? Because A, it's still coming in dollars, and B, on the contrary, equity money can come in and go out at a short notice. But bond money will stay here for minimum half a decade, if not a complete decade or longer. So these are good times to be in the Indian markets, which is why the global fund managers are saying that the Indian markets are one of the finest places to be in and to put your money in. On that optimistic note, I bid goodbye to you, not before reminding you that my friend and colleague Rahul Shah is going to share his secrets about making investing a whole lot more easier in his Lazy Millionaire Summit on the 24th of Jan at 5 p.m. Do make it a point to reserve your seat in this free summit and pick Rahul's brains and ideas for how to become a millionaire. And I also remind you to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put out here. Good, bad or ugly, I always welcome your feedback in the comment section, and please help me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. On this optimistic note, I bid goodbye to you. Thank you for your patience and watching my video. Let's be careful out there from the Omicron virus. Stay safe, Till we meet again in my next, this is Vijay Bhambwani signing off for now. Bye-bye.
The way you pick stocks, the way you build your portfolio, and the way you make money in the markets will change radically and immediately. That's my guarantee. Click here to reserve your free spot for the Lazy Millionaire Summit. See you there.